I'm still pro 30-year mortgage for all the reasons I wrote about in that chapter, but I had to change that wording. And I felt so convicted that I literally went into second edition and I changed that wording and said, at the same interest, it's a wash. Now, I gave so many reasons, and I would stand by these reasons, to why the 30-year at this is still a way better product than paying for cash from a control standpoint, the opportunity cost, potentially earning more over time, all that I still stand by. But I just want you to know, like, even me getting into this, I wrote about that because that concept of the amortized versus compound is like such a powerful thing, and yet I was called out for it. They were correct, and I changed it because they're right. And even though like I had great intentions, the version 1 that was wrong of me to write. And so I'm pointing that out to say, like, this is something I'm aware. This happens in the infinite banking space all the time. People talk about amortized interest, compound, and it drives me nuts now because I'm on the other side. I'm like, no, usually it's around selling something. And the irony about life insurance, it's usually the interest of earning versus paying is usually not on your side. There's 10, 15 other reasons why you would want life insurance and why it would still make sense. But if you're just looking at what you're earning in your policy versus what you're paying, I have news for you. It's not going to be in your best interest. And yet a lot of times the way to quote unquote sell it is to talk about amortized versus compounding. And as a result, it can be very, very problematic, and that happens even in our space. So, am I on the right track on, like, that's like the main selling point? And the other thing when it comes to velocity banking, this is at least what I've noticed from afar, is they're on one hand they're comparing, like, over if you pay off your house in 7 years, they're showing that, and then they're still comparing it to the 30 years of interest, and it's like, wait a second, like, on one hand you're showing 7 years, but you're still using the 30-year interest example. I feel like that is, I'll give people the benefit of the doubt, but I feel like that anyone that's like somewhat intelligent is going to be like, wait a second, like, that doesn't add up. Why are you comparing a 7-year versus a 30-year and making it feel like it's apples to apples?
Right. So and so the two big things is amortized interest, right? That's sort of the justification of why this works. And the other one is exactly that, is they're comparing a 30-year mortgage at a steady payment to a second scenario where they paid in the full principal amount, and they're saying, look at all this money we save you. The correct analysis, or let me rephrase that, a better analysis, right? Because would be, okay, you have to pay down the same amount of money towards the mortgage as the velocity banking or whatever, accelerated banking, whatever they call it, and then compare it. And as long as the mortgage will almost always win, almost always, unless there's a
Yep.
lower rate on the line of credit. But if you put the same amount of money in there, you have to compare that. And then the challenge to that is liquidity. They'll say, but you don't have the liquidity. My response to that is the same line of credit that you're telling people to use to chunk, have that as your backup.
Oh, I like that. So that's a perfect example where the line of credit is not bad. It's at, because that was gonna be like, I was gonna play. This is why I'm a good third person when it
Yeah, I
comes
love
to
it.
debates. Is my devil's advocate to why the first lien HELOC versus, like, if someone were to come to me and say my goal is to pay off my house fast, part of me would be like, okay, part of me would hurt inside, but if that helps you sleep better at night, okay, great.
Right.
And if they ask me, I only have two paths. I could pay off a 30-year and put extra money towards my principal, or do a first lien. If those were the only two options, I would do the first lien, even though I would disclose. I would say you're gonna pay more in interest, but I like the flexibility. But what you're saying is, like, you could just have both. And it's like you could have it wouldn't be first lien, it'd be a second lien HELOC that you could do the chunking strategy. And because the problem with paying extra towards a 30-year is you're knocking down that principal, but that money is not necessarily available to you, which control and liquidity is a really, really big deal, at least for me and a lot of the people that we talk to. Did I get that right? Like, someone could still use a HELOC and aggressively pay it down, or how would that work?